In the current economy, what is a reasonable expectation as far as where home loan rates will end up by the end of the year?
Economists and weather forecasters are the only people that can be wrong most of the time and keep their jobs.
Economists and weather forecasters are the only people that can be wrong most of the time. Economists can be wrong.
Every week, journalists ask me the same question. Where do I think mortgage rates are headed in the next year? And answering that question, it's like predicting the weather a year from now. There are so many variables involved. Reporters even acknowledge that I can't give a scientific answer to this question. They often tell me, I know you don't have a crystal ball, but what's your forecast? But as an economist, I'm one of the few people with the training to actually give an informed answer to this question. And I know that this matters to real people. Everybody is trying to navigate the economy. Everyone is trying to figure out whether they're going to be in a better economic position next year compared to this year. Everybody could benefit if they knew where the economy was headed. If you're thinking of buying or selling a home, you want to know where mortgage rates are headed. So since this is my responsibility, I'm going to do the best job I possibly can do and take this question seriously. And I have a framework for how I think about where mortgage rates are headed that I am going to explain to you in the plainest language possible. And by the end of this video, you won't just know where I think mortgage rates are headed and where I think the economy is headed. You will be able to form an opinion of your own based on this framework that I'm going to hand to you. So cue the Taylor Swift music because we're going on an economic eras tour. Okay, so the first concept that you need to understand is that your mortgage rate is basically the same thing as the 10-year US Treasury yield with a little bit of cushion on top. The 10-year Treasury yield is the interest rate that the government pays when it borrows money for 10 years. Your mortgage lender takes that number and adds a little extra for their own risk and profit. And that's more or less your mortgage rate. Now, you might be wondering why a 30-year mortgage tracks to a 10-year bond, and that's because most people pay their mortgage off in about 10 years. They don't actually hold it for 30 years. The second concept that you need to understand is that the interest rate that the government pays on its own debt is based on the growth of the economy and the expected rate of inflation. Let me give you an example. So say you want to borrow $20 from me. In my head, I'm asking two questions to determine how much I'm going to charge you for borrowing that money. The first question I'm going to ask is, what could I do with that $20 if I kept it for myself? Now, if the economy is booming, I could turn that $20 into $30. And if I can do that, I'm going to charge you more money to borrow that $10 from me, because if you borrow it, then I'm not the one using it anymore. The second question I'm going to ask is, how much is that $20 going to be worth by the time you pay me back? If there's a lot of inflation and the cost of buying things in the economy is increasing, I'm going to have to charge you more money for borrowing that money from me to make up for the fact that the money is going to be worth less by the time you pay me back. And that's really what it boils down to. There's a lot of noise that can impact interest rates in the short term, but in the long term, an interest rate is the growth in the economy plus inflation in prices. So we now know that there are two factors that can influence mortgage rates: economic growth and inflation. And with those two factors, we can extrapolate to 4 different economic eras where we either have high growth or low growth, high inflation or low inflation, and that determines what mortgage rates would be. And as I walk you through these different economic eras, I want you to think about what it would feel like to live through these different economic eras. Would it feel like the economy is working for you, or would it feel like the economy just doesn't work at all? Now, in this video, I'm going to have to talk through some pretty frightening scenarios. I'm also going to talk about some of the more optimistic, happy scenarios for the economy, but I need to understand the full range of possibilities. And I know that this feels scary. That's why they call it the fear of the unknown. But after this video, you will have a better understanding of what could happen next in our economy. And I think that that alone will make you feel more confident and a bit less afraid. Start with the bottom left era in blue. This is where economic growth is low and inflation is low, resulting in low interest rates. Now, low interest rates might sound good. It means that money is cheap and you can borrow affordably. But this economic era is one where it is hard to find a job. It is hard to get a raise. And yes, things are cheap, but we're essentially in an economic stagnation. Moving on to the green quadrant in the upper left, this is the economic era where economic growth is high and inflation is low. And this economic era should feel great. It's an era where unemployment is low, it's easy to find a job, people are getting paid a lot, their incomes are going up, and goods and services are quite cheap. It is really the best of all worlds. But because economic growth is high, even though inflation is low, rates are moderate here. They're not as low as they are in the blue economic era. Okay, let's go on to the top right corner, this orange quadrant. In this economic era, economic growth is high and inflation is high, and it feels, okay. The vibes are a bit off. It's pretty easy to get a job. The unemployment rate is pretty low, but everything is expensive. So people are generally displeased with how much everything costs. And also interest rates are high because both economic growth and inflation are high. And this means that it costs a lot of money to borrow to buy a home, to borrow to buy a car, or to have credit card debt or student loan debt. And that's why the scenario doesn't feel all that great. And now in the bottom right, this is really the worst case scenario. This is where economic growth is low and inflation is high. So it's hard to find a job, you're probably not getting paid much, and everything is expensive because inflation is high. And because economic growth is low, rates aren't as high as they are in the orange quadrant, but they're still above what they would be in the blue quadrant. So it really is the era that feels the worst for the people living through it, even though interest rates aren't quite as high as they possibly could be. If we want to understand where we are headed with mortgage rates, we need to understand which of these economic eras we are headed towards. And there are different economic trends happening in the economy that are both pushing and pulling us away from these different economic eras. Economists call these trends secular trends. The economy, it can go up, it can go down, we have booms and we have busts, but these secular trends, those are the things that determine where in the long run do we land. These are the kinds of trends that last decades, not just a few years. So this goes beyond whether we're in boom times or bust times. It's really about what's the equilibrium that we are settling into over the next decade. So I'll start with the most optimistic scenario. This is the utopia, the dream. In the top left quadrant, the green one, this is where we have fast economic growth, and yet prices stay low at the same time. And this is the world that the abundance movement is always talking about. And there are a couple of trends that are pushing us towards this optimistic world. We have AI technology. Now, I know that there are AI pessimists and AI optimists, but the optimistic take on AI is that it's going to make us all more productive, it's going to make the economy more productive, and it's going to make things cheaper at the same time. And this is that world where we have fast economic growth, and yet we don't have much inflation at all. But there are other trends that are pushing us towards this world besides just AI. We have urbanism. In a world where we have abundant, affordable housing and public transit, everything becomes more productive and cheaper at the same time. Cities also become better economic engines because more people can live in cities and participate in their economies. And then another trend that is pushing us into this optimistic world is clean energy. If we had clean, abundant energy, say from nuclear fusion or other sources, everything would get cheaper. The economy would be more productive because energy is the main input into economic growth. So more abundant clean energy would result in a faster growing economy without much inflation at all. Now, moving on to the worst of all worlds, we have the bottom right quadrant. This is where economic growth gets stuck and prices keep climbing. Things just keep getting more expensive. So everybody is getting poorer and everything costs more at the same time. It's really the worst of all worlds. And economists have this word for it called stagflation. It's an economy where the unemployment rate is high and people aren't earning a lot of money. They're essentially poorer and everything costs more. It's more expensive. So what drags us down into this worst of all worlds? Well, one is the national debt. And you can have a really large national debt without it being a problem as long as your economy is growing. But once your economy is using all of its resources to pay down its debt instead of making its citizens better off, then you're dragged down to this red region. Another thing dragging us into this red world is a breakdown in global trade. When countries are fighting with each other, having trade wars and actual real physical wars, they're not able to benefit each other and help each other become more productive in the economy. But it seems like for the last couple of years, we've been headed more towards this world of isolationism. And that makes the global economy grow more slowly, and it also makes everything more expensive. And another factor dragging us down into this red world is climate change. So one simple example is that if the climate changed so dramatically that you could no longer grow corn in the United States, we would have a whole lot of corn farmers who would be out of the job, and corn would get more expensive at the same time. So you would have lower economic growth and you would have higher prices. And in this world, even though like living in this economy would be quite painful, it would be hard to find a job and everything would be expensive, it wouldn't be that expensive to borrow money because anybody who's holding on to money wouldn't be able to do much with that in a productive manner. So in this world, you have kind of middling mortgage rates that are similar to what you have in the green world, despite the green world being much more preferable from the standpoint of anybody existing in that economy to existing in that red world. And then we have the top right orange quadrant. This is an economy that's growing, where unemployment is relatively low, but everything is expensive. Unemployment is low because there are lots of jobs, but those jobs are basically helping us stay afloat instead of helping us get to a better place. So for example, the economy right now is putting hundreds of billions of dollars towards the creation of data centers. And yes, that leads to more economic growth, but these data centers aren't actually making anything cheaper or more abundant just yet. Another example is spending a bunch of money on fighting fires that exist because of climate change. Without climate change, we wouldn't have a need for all of these firefighting resources. So are we really getting ahead, or are we just putting a lot of our economic effort into staying afloat? Another thing related to climate change is that companies are increasingly going to need to rein in their carbon emissions. Now, you could address this through something like wind turbines. Wind turbines do get us to a cleaner economy, but they cost a lot of money and they're not very efficient. So in this world, you do have a growing economy. There are economic problems to be solved that we're putting our resources towards, but we're not really getting better. We're just staying the same and everything is more expensive. And this is the world that I think that we're in right now. And in this world, we have the highest interest rates of any four worlds. And then you have the bottom left corner. In this corner, the economy is dominated by something called rent seeking. People on the left have another word for this. They refer to it as financialization. But basically, you have a lot of people, doing things in the economy that aren't actually making anybody better off. So gambling is a big category here. If you have a large portion of the economy just dedicated to making bets, you're not actually making the economy more productive. You're just trading money back and forth, and people are losing money at the same time. Another type of rent seeking that you see happens in financial markets. When the smartest people in the economy are just trying to make trades more quickly than the next guy, they're not actually making the economy better off, but those individuals, they can certainly make a lot of money at the same time. Also, wealth inequality can drag us down to this world of low economic growth and low inflation. The more money that is held by the wealthiest people, the less opportunities there are for that money to circulate in the economy. When lower income people are given more money, they spend it right away, and that can contribute to both inflation and economic growth. But when the wealthiest people are hoarding more and more of the money, that money just kind of sits idle in the economy. This is like corporations using their resources to do stock buybacks instead of investing in research and development. When corporations are putting their money into research and development, they are getting us closer to this ideal world that we could be in the green quadrant. But when they put their money just towards stock buybacks or paying their CEOs, that drags us down to this blue world of rent seeking, where yes, some people are getting rich, but they're not doing much to make the economy better off for the rest of us. But this is what corporations do. They're profit maximizers. In the words of Taylor Swift, the players are gonna play, and the haters gonna hate. Hate. This is my personal framework for thinking about where the economy is right now and where we could be headed. And I think it works pretty well because I can go back in time and I can place ourselves in these different four quadrants depending on what time period we are in. So in the late 50s and 1960s, we were in this green world on the map. We had this post-war boom where all this technology that we developed during World War II was being implemented into the US economy. For the first time, the American economy was interconnected. A businessman could get on an airplane in New York and be in Los Angeles by the end of the day. Everyday people could travel in their cars from city to city, so you had trade happening inside of the country that led to more productivity. You had the space race developing even newer technologies. You have the development of housing in the new American suburbs. And because of all of this new technology and urban planning, the economy was booming and things were getting cheaper. From a macroeconomic perspective, it really was a golden age. But then things start falling apart in the economy. In the mid-60s, you have the Vietnam War, which was an incredibly expensive war. And then in the 1970s, we had an oil shock, which sent the cost of energy through the roof. And this is how we got to a world where mortgage rates hit 18%. Nowadays, mortgage rates are about 6.5%, so nearly double what mortgage rates are today. So the Fed was slow to react to this economy. It took them a while to increase the federal funds rate in order to slow down inflation. But Paul Volcker at the Fed slammed on the brakes and he put an end to this economic era by increasing the federal funds rate. Now, you might have heard that it's the Federal Reserve that sets interest rates. And that's partially true. But what the economists at the Federal Reserve are doing is that they're looking at trends in economic growth and trends in inflation in order to determine what the correct interest rate should be for the economy. The economy can be volatile, and it's the Fed's job to reduce that volatility, to make it so that when we're riding along in our cars in the economy, it's a smooth ride instead of a bumpy one. But they don't really change the destination. Paul Volcker came in as Fed chair, and he increased the federal funds rate, which basically slowed down this out of control economy. This caused both economic growth and inflation to slow down, but it was a long and slow moderation in growth and inflation. And once the economy slows back down to more moderate economic growth and more moderate inflation growth, we enter into this next era that starts in the 1990s, our new era of techno-abundance. We have the World Wide Web interconnecting the economy just like the interstate highway and airplanes did during the 1960s, and the entire global economy becomes more interconnected. China enters in the World Trade Organization, and we start buying really cheap manufactured goods from China instead of producing them locally. And this results in strong economic growth and very negligible inflation. Nowadays, people are nostalgic about the 90s and the early 2000s the same way that baby boomers were nostalgic for the 1950s and 60s. And the reason why we're nostalgic for these times is because this was a time when the economy felt good. Economic growth was high and inflation was low. It was easy to find a job, and it was easy to find goods and services to buy for low prices. But at this time in the economy, we're starting to see more and more rent seeking. New financial products are being developed, which allows money to move through the economy without much friction at all. But also people on Wall Street are coming up with new ways to extract value out of the economy for their own personal gain. And then everything comes crashing down because of the great financial crisis. And from 2008 to about 2020, the economy is trying to get back to its old self. From 2008 to 2020, we have more than a decade of what economists call secular stagnation. Inflation is low, so things are cheap, but unemployment is also high, and the economy isn't growing much at all. Now, this is the world where interest rates are the lowest. Money is cheap. This is also when we had the Occupy Wall Street movement, which was largely a response to all the rent seeking and financialization in the economy. People were mad that the economy was not working for the 99%, but only seemed to work for the top 1%. Now, I think we started transitioning into the economy we're in right now before the pandemic. I would mark it at around 2018 or 2019 when the economy started growing and low inflation started to fade into the distance. But the pandemic definitely accelerated things. You had the Federal Reserve injecting money into the economy, directly making things more expensive. And also you had all this money flowing around in the economy, which contributed to economic growth. And even after the pandemic ended, it seemed like the economy was on this new path of higher economic growth, but also higher inflation that we are currently in right now. So this is where I get back to the original question of where are mortgage rates headed? Now, I just walked you through where I think we were at in different historical economic eras. And most recently, we moved out of this blue era from 2008 to 2020, and we woke up post-pandemic in this orange era, where interest rates are high, economic growth is pretty high, and inflation is pretty high. Now, in order for me to forecast where I think mortgage rates will be headed next year, I need to have a viewpoint on where we're going to be headed in the next decade. And it's not just about where I think the economy is headed in the next decade. It's also about where I think other market participants, where Wall Street is going wrong in its thinking about where we'll be in the next 10 years, okay? So the market already knows about AI. If anything, I feel like AI might be overhyped, and the market might be pricing in too much of a reduction in inflation because of AI technology. But at the same time, I think AI is this transformative technology that is going to make the economy more productive, and it is going to bring down inflation. So I'll just say that I don't think, AI is going to impact mortgage rates in the next year. I think that the market understands AI, and if anything, it might be a little bit optimistic about it. So I don't necessarily think we're going to be closer to the green region than markets are already pricing in. So do I think we're going to be closer to the blue region 10 years from now, more so than markets are pricing in? I think that we are getting actually farther away from the blue region. We seem to be at peak rent seeking as it is. The general public is very frustrated with wealth inequality. It seems like people are waking up to the dangers of online gambling and that will be regulated more 10 years from now than it currently is. 10 years from now, do I think that we are going to be closer to the red region? Now, in general, people, whether they're everyday people or people trading on Wall Street, are bad at pricing in disasters. They are these tail risks that people don't like thinking about, that people have a hard time comprehending. So if anything, I think the market probably isn't putting enough weight behind the possibility of climate change wreaking more havoc on the economy than it currently is right now. So in that sense, I feel like we could be drifting closer to the red region a decade from now than what the market is currently pricing in. And there are two big forces in the economy that I haven't even mentioned yet that could drastically change which quadrant we end up in. Now, one that doesn't get talked about enough is the development of countries in Africa. Africa has more than 1 billion people who are on the younger side, who are going to be entering into the middle class as countries in Africa, as their economies develop. Now, this could look similar to what happened in China, where Africa all of a sudden is manufacturing lots of cheap goods for the global economy, and that brings down prices. But there's another version of this world in Africa where the African consumer is buying a lot of goods, and that actually increases prices because they're more engaged in services and trade with the rest of the world and not with the United States. So either way, what happens in Africa, I think, will lead to more global economic growth and more economic growth in the United States. But it's not necessarily going to make things cheaper or more expensive. We kind of have to see how things play out. The next major trend in the economy is demographic change. We have an aging population here in the United States and all over the world. The global population growth is slowing down. Population growth in the United States is actually going negative. And what we've seen in the last 10 years is older people buying treasuries, buying safe assets, instead of spending their money in the economy. And this leads to lower inflation. But in the next 10 years, all of these older people are going to be getting older. They're going to need to spend their money on healthcare services out of necessity. And without young people available to provide those healthcare services, the cost of healthcare could really skyrocket. And that could contribute to overall inflation in the economy. And I think that aspect might be underpriced by Wall Street. Okay, so I know this is a lot to think about. And as you can probably tell, there are so many different forces in play, it's almost impossible to know which version of the world we're headed towards. And it starts to feel like it's all vibes and astrology instead of rigorous economic forecasting. And I'm right there with you. When we're forecasting something like mortgage rates, which depend on this 10-year timeline, it does start to just feel like we're going off of vibes. But I still committed to giving you an answer. You know, if you come to me and you ask me, where do you think mortgage rates are headed next year? I'm going to give you an answer that isn't just, they're going to be exactly where they are right now. I still think that the most rational answer to give you is that mortgage rates a year from now are going to be the same as they are today. But I understand that you want more from me, and you want me to tell you, at least, at the very least, are mortgage rates going up or down? And when I weigh all of these different factors, all of these different trends, and I think about which ones are getting priced in and which ones are flying more under the radar that could present themselves as more of a problem in the next 10 years, I start to feel like we are headed towards a world with higher inflation. I think that we are increasingly moving away. I think that 10 years from now, we will see less rent seeking in the economy, that gambling will be less accessible to people, and that they'll be spending their money on real goods and services instead of just betting it. I think that 10 years from now, there will have been a climate disaster that ends up being very expensive and very disruptive to the economy, and that could spike mortgage rates if it doesn't send us into a recession, which would lower mortgage rates. So I think it's more likely that mortgage rates will be higher next year than it is that they will be lower next year. Had to compare where we're at right now to a different year historically, I would place us in the early 1990s. In the early 1990s, we were in the Gulf War with Iran. It was causing energy prices to go up. In the early 1990s, we knew that the internet was this emerging technology that could transform the economy, but there were still many people skeptical that it was actually going to be as transformative as the techno-optimists said it would be. And it's important to note that in the 1990s, mortgage rates stayed high. I mean, they were lower than what they were in the 1980s, but they were higher than what they are right now. In 1994, mortgage rates actually spiked. So if I had to guess what mortgage rates would be like next year, I think that there is more risk of rates going up than there is of rates going down. But I want to bring us back to this green quadrant. This green quadrant is the best case scenario. Even though it's not the scenario with the lowest mortgage rates, that would be down in the blue quadrant. It's the scenario, it's the world that feels the best for people who are existing in the economy. It's the world where things are cheap and your income is high. And I think that's what everybody wants. And the reason why people who support the abundance movement are so enthusiastic about the way that technology could transform the world and the way that building more dense, affordable housing could get us to this better economy is because this is really the only way out. This is the only version of the economy where everybody gets to have those higher incomes and things are cheap. Now, of course, as we've seen historically, you can have a decade or more of technological innovation where the economy is growing, and yet the most vulnerable members of society, the people living in poverty, don't feel like their lives are improving much at all. You can have wealth inequality like we see in this blue quadrant at the same time that we exist in this green quadrant. You can have a blend of blue and green, which I think is what a lot of people are fed up with and concerned about when they're critiquing the abundance movement. It would be great if we could get to this green world, but I think what a lot of regular people have experienced and are concerned about is that, yes, the world gets richer and more productive, but it ends up only benefiting the wealthy few instead of everyone. Now, bringing all of this economic astrology back to earth, what does it mean for you that mortgage rates could be higher next year? It means that you shouldn't necessarily delay buying a home because you think that it will be cheaper next year. It might not be cheaper if mortgage rates go up. It means that you shouldn't necessarily delay selling your home because you think there are going to be more buyers next year when mortgage rates fall. There's a distinct possibility that mortgage rates go up. So if you are delaying something like a home purchase or a home sale because you've heard from so many other economists that mortgage rates are coming back down, that they're going to come back down to where they were in the late 2010s when mortgage rates were at around 4 or 5%. I want you to understand that there are trends in the economy that are pulling us towards higher interest rates. And some of those trends are going to get stronger over the next decade, not necessarily weaker. And if you want to understand what policies to support or what politicians to vote for that are going to make your economic life better off, that are going to bring us closer to this world where incomes are higher and goods and services are cheaper, you're going to want to support policies and politicians that are focused on bringing us closer to this green world. And it's okay to be skeptical. It's okay to push back on the people that are advocating for this abundant future and question whether that abundance is actually going to make it down to everyday people, or it's going to actually result in higher wealth inequality and more of the rich getting richer. You should be skeptical of that. But we also need to be focused on initiatives, technologies, and policies that get us closer to this green scenario, because that is the only scenario that actually feels good. And it's not like this is just some pie in the sky ideal. We've been in this green world before. We were there in the 90s and early 2000s, and we were there in the 1960s. But even historically, when the economy has grown, it has tended to grow in an unequal manner. So we have to find this middle balance where we allow the economy to grow, but we hold the wealthy and powerful to account when it comes to making sure that the wealth of the economy is felt by everyone, not just the 1%. And there's a flip side to this as well. We need to make sure we don't get dragged down into this red quadrant either. We need to reduce global carbon emissions so that the impact of the climate doesn't get even more severe than where we're already headed. We need to make sure that our government spends money responsibly in a way that promotes economic growth instead of just growing our debt to no end. And we also need to maintain diplomacy and economic trade in order for the United States to really benefit from the global economy instead of isolating ourselves into an economy where things are more expensive and less productive. I hope that I'm underpricing the possibility of us moving into this green quadrant. But in the short term, I'm not sure. I feel like we're not taking these economic trends seriously enough. And if we're not avoiding this red quadrant, we might be headed right towards it. So as an everyday participant in the economy, I just need you to moderate your optimism if you haven't already, and be prepared for a world where mortgage rates go higher instead of lower. I'm Daryl Fairweather, Redfin's chief economist. If you like this video, please let me know by clicking that thumbs up button. Subscribe for more videos, share this with your friends who also want to know where the economy is headed. And let me know in the comments if you think what I said was any better than what an astrologer might say. Till next time, bye.